Hi everyone, my name is Joseph-Antoine Migdalani. Today I am with Karim Zakir, our portfolio manager. Welcome to our quarterly web capsule. Before we start, we wanted to quickly apologize for the delay of publication of this video because of major renovation in our branch in Kirkland. Now it's fully done, brand new offices, so we're super happy. You could definitely come and visit us more often now.
Be a pleasure.
Yeah, and Karim, let's jump right into the subjects that our clients like to hear about.
Yes.
The markets, we had not a tough beginning of the year, but it was volatile, a lot of uncertainties with the war and stuff like that. So, quick question, just to set the tone, what do you see in the financial market right now?
I see pessimism, but I think we've passed maximum pessimism. I think it's behind us. But we have to say that the market has been extremely resilient in the first quarter.
It was. Yeah.
Okay, market took a lot of hits, and with all that, it didn't do too badly overall. It could have done a lot worse, but we still came out of it so far. So far, it's looking okay.
And with all the negative headlines that we keep hearing and seeing on the TVs, how did our clients' portfolio react?
Quite well overall. January and February, as our clients look at their statements, they were nicely up. Everybody across the board.
Mm-hmm.
March was a negative month, and overall, by the end of the first quarter, we had a slight increase in the portfolio from January 1st to March 31st.
And with the midterms election that are coming, what are your thoughts for the next few months?
Volatility,
right?
Lots of volatility.
Mm-hmm.
It's very natural. It happens at every second year of the presidential cycle. If you go back 80, 90, 100 years, the second year of the presidential cycle is always the most difficult for the markets. It's very volatile because of the uncertainty leading up to the midterm election.
Mm-hmm. How should we position ourselves and the client's portfolio in an environment like that?
Well, normally, I forgot to mention that by the fourth quarter, after the midterm elections, the markets rebound.
Mm-hmm.
So expect volatility the first three quarters. The last quarter will probably be a rebound. Historically, that's what tends to happen in the markets. In terms of positioning the portfolio, we got to stop at all the bluster and all the headlines, and we got to look at the facts, okay? And the facts speak louder. I don't look at the news to a point where it makes me emotional. So stay the course. No different than a pilot has to stay the course going towards his or her destination. There's going to be turbulence along the way, but they're going to get us to the destination.
Right.
We manage the portfolios within the same context.
Absolutely.
Don't try and time the market, because if you miss out on the big rallies that tend to happen, you lose significant returns down the road.
And you've mentioned to me earlier this week that we are in a kind of a new market paradigm. What do you mean by that?
Yeah, you said it perfectly. We're in a new paradigm. We're no longer in the era of the Obama period, and we're no longer in the era of the Biden period, where inflation was low, things were generally calm geopolitically. I believe that we're in an environment that is very similar to the period of the 1960s and 1970s, where inflation starts to take precedence more and more, where the S&P has not really performed that well from a real return perspective between those 20 years. What has outperformed the S&P 500 during this 1960 to 1980 were commodities. I believe that in the next 5, 10, 15 years, that's the new paradigm we're faced with.
Mm-hmm. Let's talk about geopolitically.
So if you think about it, facts. Ukraine's been unfortunately hurt. Their infrastructure is broken to pieces. Israel is having issues. Iran, of course, is being destroyed. Lebanon is being destroyed. Not to mention the infrastructure that belongs in the UAE, in Kuwait, even in Saudi Arabia. There's destruction everywhere. All that destruction means we're going to need materials to rebuild post-war.
Mm-hmm.
It's going to happen. We're going to have a post-war era sooner or later,
Right.
and we need to rebuild. That rebuilding is going to request tremendous demand for materials and commodities in general.
And beyond rebuilding, is there another place
Yeah.
where you could see demand?
If you think about it, AI, okay, we got to build data centers. Data centers require a tremendous amount of resources, electricity, natural gas, steel, aluminum, copper for the wiring, etc. We have electric vehicles that are taking more and more space, and not to mention robotics.
Right.
Robotics is the future. It's coming, okay? And all this is going to require materials, energy.
And what does all of this mean for inflation and portfolios?
Scarcity means inflation. So we're going to be in a new inflationary type of environment that's going to go for the next few years, 5, maybe 10 years. And so we need to hedge the portfolios accordingly.
What's your outlook for oil?
With the Strait of Hormuz being blocked and the geopolitical issues we have now in that part of the world in particular, there's going to be a premium attached to the barrel of oil from now on for at least the next 3 to 5 years, in my opinion. And it's our opinion. It's not necessarily the opinion of National Bank. I just want to make that clear. I don't see the price of the barrel going back down to $40 or $50. I wouldn't be surprised even, I don't think oil is even going to go down to $60 a barrel like people anticipate.
Mm-hmm.
Throw in the $10 I estimate as being a premium, you're looking at minimum $70 a barrel oil, which is higher than where it was before this war broke out.
Yeah.
Again, inflationary.
And do you see any countries making like partnership and alliance together, like working together more and more?
If you look at the allies that are developing in the world, okay, you got Russia with China, with North Korea, with Iran, who represent approximately about 20% of the world population.
Mm-hmm.
They're becoming they're allies now, okay? The United States, unfortunately, has broken its relationship with many of its allies.
Right.
Deglobalization,
Yeah.
we call it. So again, more uncertainty, and this is just going to be a problem going into the future, which means that we need to hold real assets.
Yeah.
Real assets like commodities, agriculture, steel, copper, oil, natural gas, so on and so forth.
And gold.
So gold is more, yes. So gold is a monetary asset. It's a precious metal. It's an inflation hedge long term. Gold just incidentally has outperformed the S&P going back 20 years in a row. It's outperformed it over the 20-year period. I believe gold's going to continue its outperformance going into the next 5 years. I wouldn't be surprised to see gold much higher by the end of this decade. We need to hold a position in gold in every portfolio. It's an inflation hedge. It's defensive. It's a great diversifier. Everybody should hold a portion of gold bullion. I'm not talking gold miners in stocks and equities. I'm talking gold bullion.
Right. How would you sum all of this up for clients watching today?
Patience, patience, and more patience. I'm going to quote a French playwright, Molière, who always said, "Trees that grow slowly produce the best fruit." So patience is key. Stay with your strategy. Don't deviate. We will get you to the destination that everybody is looking for.
Thank you so much, Karim. Once again, just to finish this quarterly web capsule, just a quick reminder that if you have any questions concerning your portfolio or you would like to book a meeting to discuss financial planning, retirement planning, estate planning, feel free to reach out and we're going to be more than happy to book a meeting with you. Thank you so much for watching and we'll talk soon.